I would like us to welcome the VP of Growth and Innovation and two-time podcast host at the Innovators the Investors, podcast network, as well as the founder and managing member of Piranha Capital. He holds an MBA in accounting and finance and a BSBA degree in finance and economics, as well as the Certified Management Accountant CMA designation. So he is passionate about stock and real estate investing, personal finance, side hustles, and enjoys giving back by joining the boards of companies making great changes in the world. So I ask you to join me in welcoming Mr. Robert Leonard.
Woohoo! Welcome, Robert.
Welcome, Robert. So we just wanted to start off by asking you to share to share a little bit with us about your journey as an investor.
Yeah, so I started investing, I think it was my freshman year of high school. I actually was brought into investing from a get-rich-quick scheme gentleman who was posting ads on Facebook. He was touting how he could help you get rich overnight. And as a young, high schooler, it was something that really, caught my interest. So I started to study what he was doing, and he was a penny stock day trader. And so that's kind of how I started out, as I was learning these strategies from him. And then I realized quickly that that wasn't really a great way to build long-term sustainable wealth. And so from there, I evolved into finding Warren Buffett and many other value investors, and I started to study Warren. And ever since starting to study Buffett, I've been a big value investor and just been studying it for almost a decade now.
Wow, that's quite some experience there. So we look forward to benefiting from some of that. All right. So with all of that experience, all that you've learned over that time, what would you say is your investment philosophy?
I am definitely a value investor. Most of us here at the Investors Podcast Network, we are value investors. That's our main focus. But over the years, what being a value investor has meant for me has changed a lot. So when I first started investing, I thought that value investing was just buying companies that had low PE ratios or low price to sales or whatever metric you wanted to look at. If it had a low ratio, I thought that was a value pick. And that was my interpretation at the time. I thought I could just run a discounted cash flow analysis. And then if it said that there was going to be a good return that was acceptable for me, I thought I could just buy it and it would turn out to be a great investment. I quickly learned that there's a lot more to stock investing than just running the numbers from financials and then making an investment decision. And so I have evolved to include a lot of qualitative analysis in my thesis generation, because it's not just about the financials. If it was just about the numbers, you could have these supercomputers that are out there these days instantly buying these companies. If there's any sort of undervaluation, they would just instantly buy them up and that undervaluation would go away almost immediately, making an efficient market. So what we need to do is find value. As value investors, we need to find value, or if we're growth investors, we need to find growth in companies that people can't find in the numbers. So you need to find the story or the qualitative feature of that company that is going to make them stand out from the market. So I started as a purely quantitative guy, similar to Toby Carlisle, if you guys are familiar with him. And I've kind of transitioned to more qualitative, and I actually do a little bit of growth now, but mostly value. And I dabble a little bit with some derivatives, mostly in the options markets. And as you mentioned, I do real estate as well, but predominantly a value investor.
Okay, great. So you mentioned a few terms there. You mentioned being a value investor, and you also mentioned growth investment. But what do those terms mean? And what are the other types of investor categories?
So being a value investor, the concept is actually pretty simple. It's just buying something for less than what it's actually worth. Now, it's simple to understand that, but it's hard to actually put into practice. There's thousands and thousands and thousands of people in the world, probably millions, working on trying to find all those undervalued companies, people that have a lot more money and resources than we do as individual investors. So that's what makes it difficult. Being a growth investor, that is when you're typically buying companies, you still want to buy companies that are undervalued, but the way you value them is a bit differently. They're not, usually growth companies aren't profitable. They're usually not cash flow positive. Usually they're growing revenues at, double digits, 20, 30, 40%. And that's basically the investment thesis, is that you're expecting the company to continue to grow significantly more than a growth company, a value company or other companies similar. So you could take a company like Uber or, companies like that. Those are considered growth companies, and there's tons of them. Whereas you'll see a value company typically like Johnson & Johnson or some of your more blue chip type companies. Other strategies, you can have day trading, where you trade in and out of the market in very short periods of time, usually within a couple minutes, maybe a couple hours. You very rarely hold overnight. There's other just purely quantitative strategies. There's completely algorithmic trading. So you'll see there's one of the largest hedge funds in the world, Renaissance Technologies. They trade almost exclusively using algorithms, and they've done very well. So there's a lot of different strategies that you can implement.
Okay, so I have it's a birdie asking about algorithm investing. What can you share a little bit more about that and how it's done?
Yeah, so basically there are, and I'm no expert on this by any means. I don't really follow this strategy. I don't have the equipment to do it. Not many people do. You really need to have a very sophisticated and powerful computer, a supercomputer, to really be able to do this. But basically what they're doing is you have these quantitative programmers who are basically data scientists that also understand finance, and they are scraping historical data from the market, basically looking at all of these different trends and back testing as much data as they possibly can. And then they are putting that into algorithms and testing all of these algorithms over and over and over and back testing it. And what back testing it means is they're testing it over a period of time that has already occurred. And so they're saying, if I had been implementing this technology or this algorithm over this period of time, what would my return have been? And so basically, once they've developed these algorithms that they like, they need to tweak them so that they have certain volatility, so they have certain holdings. They program a computer so that anytime a security meets their specific criteria within that algorithm, their computer will instantly buy it. So the second that a stock trades, sometimes if it goes below a 200 moving average, as soon as it goes below there, the supercomputer will instantly buy it. And so that's basically what algorithmic trading is. Like Patrick said on the Facebook Live, Renaissance Technologies, they're the largest company doing it. Mm-hmm. And if you can figure it out, you can do very, very well. I think they're averaging over 60% returns annually for over 20 years now. So it's pretty incredible. It's not something that average investors can really do without a supercomputer.
Understood. Thank you. I think we have quite a few persons in our group who would be interested in that type of technology and that type of investing, actually. Okay. So for those who may not be so familiar with the Investors podcast, can you tell us a little bit about that?
Yeah, absolutely. So the Investors Podcast Network is what we are called now. We originally started as just one podcast founded by Preston Fish and Stig Broderson. About 4 or 5 years ago, they got together. They started writing they started just with a blog or a website. Then they added a forum, and then they started writing some books. And then they said, well, why don't we do a podcast? And so they started a podcast pretty much explicitly studying Warren Buffett and the strategies of value investing. and it was the first of its kind. They were very early on in the podcasting trend, if you will, and it grew and grew and grew. And today that show is called We Study Billionaires. It's our flagship show, and it is currently doing download numbers the size of CNBC. So it's very large, and it's the largest stock investing podcast in the world. So given its size, they decided that they wanted to leverage the brand. So you see this in traditional cable all the time. You'll see networks leveraging their brand to launch new shows. And so that's happening in the podcast space. And so Preston and Stig decided that they wanted to leverage their brand that they had built and launch new shows. Long story short, I got involved with them, and we launched my show as my first show as the guinea pig for that idea, to see if it worked, see if it was something that was worthwhile to continue to do. The first show, Millennial Investing, has done very well. And so we went on to launch 2 more shows, and then we launched another show. So we currently have 5 in the portfolio, and that's what makes us the Investors Podcast Network. We also have all kinds of different resources. We have our Facebook group. We have all kinds of just different products and services that we also offer in addition to the podcast. But that's what we have going on at TIP.
Awesome. We're fans, so we're familiar. And I'm hoping that through this, some more persons will become aware and go check it out. So what are some of the benefits you would say, though, of joining the group, of joining the Facebook community and listening to the podcast, etc.? How do you think it can help?
So I'll talk to the Facebook group first, and then I'll talk about the podcast. So the Facebook group is great because it's completely free, and we currently have almost 800 members. And so I'm very active in there. I'm answering questions. I'm making posts frequently, so you can interact with me. You can also, but it's not just me. Like I said, we have almost 800 people in there today. We just started the group about 6 months ago, so it's growing very fast. You guys are both part of the group. And so there's a lot of active people in there with the same mindset. We're all interested in investing. We all want to learn about these topics. We all want to become better investors. We all want to reach our goals, and we all want to, do better for ourselves. So you just have an entire community that is trying to help each other. We can all learn together, ask questions. And so it's really great. And then also, because people are being a part of our community in the Facebook group, I'm trying to give away a bunch of free resources. I'm working on creating a bunch of great stuff to give away for free in the Facebook group. Right now, we have 3 free full courses on how to analyze stocks that are available in the Facebook group. We also have some other spreadsheets that I give away, and I plan on giving away some more stuff for free in the group. So that's the benefit of being a part of the group as well. On the podcast side, it's really a medium to learn these days that wasn't available before. So maybe you don't like to read books, but you still want to learn about this. You can listen to a podcast, whether it's one of ours in our network or not, whether it's something else. Podcasts are a fantastic way to learn. You're able to learn from some of the most amazing entrepreneurs, investors, and business leaders in the world that you probably couldn't access otherwise. I've had Robert Kiyosaki on the show. We've had Jesse Itzler. We've had Lewis Howes. We've had some really amazing, very well-known business leaders that you are able to learn from. And I often ask for listeners' questions in the Facebook group, so you can get your questions asked to these people and then hear it on the podcast. So I try to make it super interactive. And there's just a lot of really great information to learn on the podcast. And, probably the best part is that it's all completely free. So we'll never ask you for anything. You can listen to the podcast completely free. Facebook group, it's all completely free.
Awesome. I heard spreadsheets as you were talking just now, and I know for sure that Chica will be happy to hear that. All right, so as we are in this pandemic, this season now, let's talk about that a little bit. What is your assessment of the current market?
So do we want to talk about the real estate market, or do we want to talk about the stock market first?
So let's talk about the stocks first and then the real estate.
Sure. So the first thing I'll say is that I think people need to take a step back and really think objectively and go and think second level. Don't just read news headlines and make a decision. Don't just, see something on social media or on the internet and think that you know the whole story, because there's a lot more to it. We need to use second level thinking if we're going to be successful investors. And the reason that that's important is because if you look at a stock chart over a short period of time, if you look over the last month or even year to date, you're going to see a huge drop. And that's because we've seen a 30, 40, 50, 60, 70% drop in some cases. And that is large. But now if you zoom out, and of course the media is going to make that seem horrific. And it did happen very fast. It was one of the fastest drops we've seen, I think, ever. And so, but you need to take a step back, zoom out. And so if you look at that chart on a 5-year perspective, now that drop doesn't look like so much. It really, in most cases, it really is just a small blip. And so I was looking at a couple companies. I was reading the headlines that things were dropping and significantly. So I of course ran to my watch list and I started to look at some of my favorite companies and I'm like, all right, well, what can I go buy? What are on sale? And I started to look at them and they were down 30 or 40%. And then I zoomed out on the graph to look at the chart and I could see that it had only given up gains from, say, November, and we were in March. So I'm like, that's only about 5 months of gains. That's really not super on sale. But a lot of people are just reading the headlines and seeing that the market's in turmoil and thinking that everything is on sale. So I think that's the first thing that people need to remember. And the other thing is that just because something has fallen doesn't mean it can't continue to fall. And I talked about this on one of our podcasts recently, that one of the things I've learned is just because something looks cheap doesn't mean it is, and it doesn't mean it can't continue to fall. I've bought stocks before when I was first starting out that I said, these have already fallen so much, there's no way they can go any lower. And I've learned that that is not the case. Research shows that stocks can go lower and they can always go lower. And if you buy something at 100, and it dropped from 200, let's say it dropped from 200 to 100, it's already down 50%. But if you buy in at 100, it can still go down 100% from where you bought it. So there's always more downside. So keep that in mind. And the other thing is, things might look cheap right now, but you need to remember that you're looking at that based on today's price with historical financials. And that doesn't align because we're not going to have those same financials going forward. If we were, then we wouldn't see the price fall like we have. Because of that, you need to make an adjustment to those earnings. So if you're seeing something that's trading at what looks like to be a small PE ratio, for example, price to earnings, you need to remember that those earnings are probably going to fall a lot over the next 6 months to a year. So now you need to adjust. So you need to do an adjusted PE. And when you do that, it's not going to look as cheap as it once did, because those companies their revenue is going to fall, their profits are going to fall, their cash flow is going to fall. So you need to take that in consideration and really look at it on what it's actually going to be like, not historical, because that's not a good representation of it.
Okay, great, thanks. So if it is, then based on what you're saying, what would you recommend if someone, say, has $100 to invest right now? Would you recommend that they go all in with that 100 on a stock now, or incrementally invest in the stock since there is always more downside?
I pretty much always recommend that people buy in chunks. That's what I do personally. So, I can't give specific investment advice, of course, but for me, I can tell you what I do personally. I've been buying in throughout this dip ever since it's been falling. So it fell 10% and I said, I'm going to buy some. So I did. And then it fell another 10% and I bought some more. And then it fell 20% and I bought some more. And so I'm just continuing to buy. And if you're working for an employer that has a 401k, I've been getting asked a lot if I should stop contributions, things like that. I tell people no, because now is when those contributions are extra valuable, because now that the stocks are depressed in price, you're buying more, which is exactly what you want to do with dollar cost averaging. So for me personally, I would recommend buying in over time, not just dumping that money all in at once.
Okay, great. Thank you for that. And now let's talk about the real estate side. What is the market looking like for real estate now?
So I know that we have people from all over the world. I know we have in your group most people from Jamaica. Here on the Facebook Live, we have people from all over the world. We've seen people from New Zealand, people from the US, England, all over. So it's going to be a little bit different everywhere. So you need to think about your specific markets and exactly how they're going to react based on where you live. But I'll talk to here in the US, and I'm guessing it's probably going to be pretty similar in other parts of the world. But basically, the stock market, it reacts very quickly because we have a computer. Everybody's on a phone or a computer right now listening to this, and they can log into their brokerage and sell all their stocks or buy stocks. So they move very quickly, and there's a lot of volatility. That doesn't happen in the real estate market. And so we don't know necessarily what's going to happen yet. Nothing has really happened. It's such a lagging thing in the real estate market because right now, people are still able to make their mortgage payments. Some people are still paying rent. So we haven't seen a lot. I think the next 6 to 8 weeks are going to be very, very telling. We had Neil Bawa on the real estate podcast not too long ago to talk about how COVID-19 was impacting the real estate markets. And he said that basically what I just said is that it's too early to tell exactly how the real estate market's going to be impacted. I think it's a general consensus by a lot of people that in June, July, August, we're going to see a lot of adults to make their mortgage payments, and then that could lead to a flood of supply to hit the market, and that could suppress prices because there's not going to be as much demand. So we'll see how it's going to play out over the next 6 to 8 weeks, but it's really hard to say where we are at now.
Okay, thank you. All right. So we're going to dig a little deeper in the real estate side of things. You would have said, of course, that we're from different parts of the world, and so the markets are a little bit different. But we're going to be talking about just some general guiding principles, because you're right, there are some things that are similar. So for those general threads, what would you say to someone who is seeking to acquire their first property? What should they look for? What should they avoid? And what is the recommendation in terms of investment? And when I say that, I'm asking, if I'm living in a rental space right now, would you recommend that I purchase another property for investment before I purchase a property to live in, or vice versa?
So I think the answer to that is going to depend kind of on the loan programs you have in your country. So if you have something similar to what we have here in the US, where you can get a down payment loan to purchase a property, I think hands down the best way to start investing in real estate is to buy a property to live in that has multiple units. So buy a 2, 3, or 4 unit, and then live in units and rent the other out. Pretty close to free, so reducing your largest expense. So that's how I would recommend most people start. You only have to live there for a year. So you can live there for 1 year, live there almost rent-free or very cheap, and then once the year is over, you can move out, and then you can rent that property out, and then it becomes a traditional rental property, just like if you had bought it as a rental to begin with. And then you can do it again, and then do it again, continue to do it multiple times. I've done it twice so far, and I'm about to do it a 3rd time. So it's a strategy that you can repeat over and over and over. It's a good way to build your portfolio without having to come up with a lot of money down. Now, you talked about some of the other principles, guiding principles that are applicable across the world. And I think probably the most important one that is universal, no matter where you are in the world, is having enough reserves for free money. So I know a lot of people that try to squeeze into a real estate deal almost by the skin of their teeth. So they say, okay, the down payment's $10,000. I only need $10,000 to get into this deal. And while that's true, you can buy the property for that amount of money. What they're not considering is if something breaks in the property right after they buy it, or anything else along that they're going to need capital to handle. If they can't find a tenant, or if a tenant leaves, or if they need to evict someone, or whatever the situation may be, they're going to need some sort of money to pay for those types of things. So I see a lot of people going without enough reserves. And so I think the biggest thing is to make sure you have reserves. For me personally, I invest in all my rental properties with a business partner. Thankfully, him and I are on the same, we have the same philosophy. So, and we've decided we both work full-time corporate jobs, so we don't necessarily need the cash flow from our rental properties. And so we've made it to not take a dime from our rental property. So everything we've ever earned from our rental properties stays in the bank accounts for those rental properties. And then once we have enough to keep our reserves and then enough additional, we'll take that money and we put it into an additional property. And that's done really well for us right now. You know, everything happening with COVID-19, we have about 12 months of reserves set aside. So our properties could essentially sit vacant for 12 months and we could still service our debt. We could still pay our mortgage and be okay. And so that puts us in a really strong position to go forward. So I think the first thing and most important thing I'd recommend to people, no matter where you are, if you're looking to invest, start with what they call a house hack, buying a property with multiple units in it so that you can live there and rent the rest out. And then also make sure you have enough reserves for the property that you're trying to buy.
Great advice. Okay. Yeah. So just a quick reminder for our participants, guys, you're welcome to ask your questions in the chat, and Robert will be here to answer them during the Q&A shortly. So before we go into the Q&A, we wanted to talk just a little bit more about stocks, and to get your feedback on what stocks you're watching now and why.
Sure. So I want to preface this by saying, just because these are stocks that I'm interested in, that doesn't mean you should run out and buy them. You know, you could certainly I'd recommend doing your own due diligence and seeing if they fit your risk profile, if they fit how long you're going to plan on holding a company, or if they just fit into your general portfolio. And if they do, then feel free to purchase them, but don't buy them strictly because I am. So I want to mention a few of the companies that I'm looking at or that I own. And my largest holding by far is a company called MasterCard, ticker MA. And on one of our podcasts, the We Study Billionaires show, we did an intrinsic value assessment. So we did a deep dive into MasterCard and its valuation. There's a ton of great information in there. So go check that out if you're interested in MasterCard. But for me, that's my largest position. It's followed by Visa, which is my second largest position, very similar to MasterCard. They do the same type of thing. They're actually competitors with one another. That is ticker V. I also have large holdings in Markel and Adobe Systems. Those are my largest 4 or 5 holdings. And those are tickers MKL for Markel and ADBE for Adobe. And so the reason why I'm purchasing these companies is they haven't necessarily fallen the most. Like you go and you'll see cruise lines, you'll see hospitality and travel and companies like that are really struggling right now. At one point, Carnival Cruise Lines, ticker CCL, was down 70 or 80%. There were a couple other companies that I was looking at that were down almost 90%. And so these companies are not falling that much because they're quality companies. And so the way I think about this is we're not investing in a vacuum. And this is one of the biggest things that I learned going back to when I was investing strictly quantitatively. I was thinking, if these numbers make sense, I'm going to buy it. And I wasn't thinking about all of the other things, all the opportunity costs that I had. Because if you buy one company with that money, you can't buy the other companies that you could have potentially bought. And so not only do you need to consider the return that you're earning on that one company, but you also need to consider the return that you're giving up. Because if you buy a company and you earn 10%, that might be a great return and you might feel really great about that. But if you could have earned 20% in the other company, that 10% isn't as great. And so that's something that I learned. You're not investing in a vacuum. You need to consider all of the other companies that you could potentially invest in. So for me, when I look at some of the companies that have fallen, Carnival Cruise Lines, Marriott Hotels, things like that, I compare that to MasterCard or Visa or Markel or Adobe or PayPal or Square. That was one of my other large holdings, Square, ticker SQ. And so when I consider those versus those companies, for me personally, it's a no-brainer that I don't want to even mess with those companies that may or may not even make it through this pandemic. I feel much more confident in these other companies that I've been following for a while, that I know are great companies, that they're trading at fair valuations. You could argue that Carnival Cruise Lines and these other companies are trading at a better valuation. They are likely cheaper than the companies that I'm buying. But there's a lot of risk there, and that's not worth it to me. I'd rather have a little less potential upside than have that risk. So with a company that's fallen 90% and that's relatively small compared to MasterCard and Visa, there's more upside there. But with MasterCard and Visa, I just like those companies a lot better than the other ones that have fallen so much. And so one of the reasons that I also like it is whether they get the buyout or not. Some of these companies need buyouts, airlines, the cruise lines, things like that. They need a buyout. They need free money from the government in order to stay solvent, to continue as a going concern, to be able to even stay in business. For me personally, that's not really the type of business that I want to own. And I'm buying these companies to own for the next 5, 10, 15 years. And so when I think about it, that's just not really the type of company I want to buy. And the reason for that is because, and I'm going to talk a lot about MasterCard. You could probably tell that I like that company a lot, but there's companies like Carnival Cruise Lines, and I'm going to use them as an example on the bad side and MasterCard on the good side. So there's companies like Carnival Cruise Lines that are getting money from the government or potentially getting money from the government just to stay alive, just to be able to continue as a company. And then there's companies like MasterCard. They're not getting money from the government. They don't need it. They're very high cash flow businesses. But what they're doing, and this is proving how good of a company they are, how good their management team is, what they're doing is they're going out and they're raising money. They're raising debt. They're issuing debt at extremely low interest rates across the world. And they're getting all that cash in at very, very low rates. And they're just socking it away for now because they don't necessarily need it right now. So they're just going to issue all the debt that they can at super low rates, make sure they can still service it, of course. And then they're going to park it on their balance sheet. And then as things start to slowly turn around, they're going to start to really deploy all of that cash. And they're going to earn way higher returns on that money than they are paying in their debt service. So their cost of capital is much lower than their ROI, which makes for a very positive investment. So when you have companies that are able to issue debt at extremely low rates with the interest rate environment that we're in, and they can invest in the company to grow for the long term, that is just such a better opportunity, in my opinion, than it is to buy a company that needs a handout from the government to potentially, even stay as a company, as a going concern. And the really tough part about this is there's a lot of people that are new to investing. I've had a lot of people reach out to me and say, should I buy Carnival Cruise Line? Should I buy these airline stocks? Should I buy these hospitality companies? And I can't really answer that because that's not how I invest. But what they see is they see people that bought at the bottom and then it's doubled in 2 or 3 weeks and they think it's a good investment because they're new investors. They haven't studied, they don't know the research. They haven't read all the books. So they don't know necessarily why that means it's not a good investment. Just because something goes up in value over a short period of time doesn't mean it's a good investment. So if anyone listening to this on Facebook Live or in your guys' group, I caution you to think that just because a stock has doubled in value over a few weeks and you bought at the low, that doesn't necessarily mean that it was a good investment.
Okay, got you. We're pretty clear on that one. And it goes back to what you were saying earlier about your strategy of being a value investor. So you're investing according to the solidity of the company versus just the stock being on sale per se. Also, MasterCard is actually making a big push right now for this region, for the Caribbean region and South America, etc. So they are expanding, and we're seeing that play out in our market right now. So I can imagine that would in fact be a good buy.
Exactly. MasterCard and Visa, they're expanding significantly into emerging markets, and that's where we see a lot of potential growth for these companies.
Right. Okay, and our final question is about asset allocation during this time, in this climate. What would your advice be in terms of an asset allocation strategy?
So it really depends on what you're buying and how you'd like to run your portfolio and what your risk tolerance is. For me personally, I like a lot of risk. I like to run a very concentrated portfolio. So if you look at my portfolio, the top 5 holdings that I have, the top 4 or 5, they account for, I think I own 17 or 18 companies in my portfolio. So you might think, well, that's not very concentrated. But when you look at the percentages of my portfolio, it is actually pretty concentrated because the top 4 or 5 of my holdings are 85 or 90% of my portfolio, and the remaining 12 holdings only make up the next 15 or 10 or 15%. So I would consider that to be a pretty concentrated portfolio. And if you look at Warren Buffett's portfolio, which you can look at his 13F filings, or you can look at, there's a website called dataroma.com, and they provide all the super investors' portfolios. So if you look at his, you'll see a huge list of of companies in his portfolio. But when you do the math, you can see that the top 3 or 4 holdings make up a significant portion of his portfolio. So if you're comfortable with that, I think that's a great way to go about it. That's how I like to invest. But it depends. If you're a little bit older than me, I'm only 25 years old, so I have a long time. I can hold these companies through a lot of the volatility. If you're a little bit older, then you might need to diversify a little bit more. If you think back to how you've been handling this crisis, if during this crisis you're seeing the stock market crash and your instant emotion was that you need to sell, then I would recommend you don't buy a concentrated portfolio or hold a concentrated portfolio. If that's your emotional state, that's completely fine. There's a lot of people that are like that. I would highly recommend that you look at ETFs. They'll provide you great low cost diversification that own great companies. And then you can also buy some individual stocks, but I would not run a concentrated portfolio. I would keep your position sizes very small, keep them to maybe 3-5% of your portfolio, and then diversify that way. What's great about that is before it was difficult because we had trading commissions, we had things like that. So if you're in a part of the country or world where you don't have trading commissions anymore, you can buy a few shares, just one share, and it doesn't matter because you don't have that commission taking out from your investment. And also you can buy fractional shares with a lot of brokerages these days. So if you need to hit that 3 or 5% allocation in your portfolio, you can do that without taking in any fees, and you don't even have to buy a full share. So if you want to buy Amazon, but if you buy one whole share of Amazon, because I think it's almost $2,000 USD, that's going to that could be more than 3% or 5% of your portfolio. So to get it to that percentage that you want, just buy a fractional share. And if you want to run a concentrated portfolio, that's fine. You can do something similar to what I do, and you pick your top 5-6 companies, 3 to 5 companies, 3 to 6 companies, and invest the majority of your portfolio there. And then you could make some more speculative plays with other companies that you want. Make sure you keep those positions small. We haven't really talked about it a ton here, but Bitcoin, I also have a position in Bitcoin. I kept that at 1% of my portfolio. I have a lot of companies that are at just 1% of my portfolio. Zoom Technologies or Zoom Communications, which has been very popular recently with COVID-19. Unfortunately, it was only 1% of my portfolio because it's more than doubled since I've owned it. But that was, again, because even though it was only 1%, it's gone up so much that it actually had a good impact on me. But if it went down, it wouldn't be as impactful because it's only 1% of my portfolio. So think about how your personality fits the type of allocation that you need to meet. For me personally, when I saw things go on sale in the market, I was ready to buy. I have not thought about selling once. I have not sold anything. And so for me, if you're like that, if you felt confident, you liked what you own, and you were ready to buy more as the market tanked, I think you can run a more concentrated portfolio. If you, like I said, if you wanted to sell when things started to crater around you, then I think you need to run a more diversified portfolio.
Great advice. So thank you so much for sharing with us. Thank you so much for sharing with us, Robert. We do have a few questions for you at this time. I see one from Antonio. Antonio, would you like to unmute and ask Robert the question directly?
Yes. I'm not sure if I could hear me.
We can hear you.
Okay. So one of my questions is, after you paid off your debt, from your strategy, do you start first building your savings of nest egg, or do you start investing immediately, or like a hybrid, or it all depends on where the market is at? What do you think?
That's a really good question. And so what I do a little bit different than I think some other financial experts is I recommend, so if it depends what you're talking about investing first off. So if you're talking about investing outside of an employer-sponsored account, so if you're in the US and maybe other parts of the world, I'm not sure if they offer these types of programs, but if you're investing in a 401k and your company is matching, I think you need to take that match. You need to invest at least up to the match almost always. Unless there's some circumstances where you wouldn't want to do that, but almost always I would highly recommend that. But outside of that, if you're talking about investing in other accounts that are not 401k related, I take a strategy of you need to have at least some sort of nest egg first. And Antonio, I know we've talked before about real estate investing. You wouldn't build a house on a weak foundation, and it's the same with investing. You need to have your personal finances in order before you start investing, and I don't think you can have a strong personal finance foundation without a nest egg. So what I recommend, and of course you want to start investing as early as possible, but what I recommend is at least save 3 months of non-credit card payable expenses. And so what that means is if you have a mortgage, you likely can't pay that with your credit card. If you have an auto loan, you likely can't pay that with your credit card. But if you have other bills that you can pay with your credit card, then you don't necessarily need to save that right away. I think you should eventually save that money and build up your nest egg. But I think what I would do first is save at least 3 months of a nest egg for expenses that you can't pay with a credit card. And then you can start investing, but still continuing to build your nest egg.
Thanks.
Awesome. Thanks. Our next question is from Chica. Chica, you can go ahead.
Hi, Robert. Good night. I just want to say it's an honor to actually have you here, give this presentation first and foremost. I started following the Investors Network, as a matter of fact, in about 2017. So I just wanted to know you to know that you're in, well, the team's Investing 101, 102, 103. That was basically my catalyst for everything afterwards when I really started to invest and where we are right now. My first question of actually many is pretty much how do you as a qualitative investor, right? What are some of the key indicators you could give us of the company that we would be looking for? Because value investors, as you said, you use the term and everybody knows it, intrinsic value we're looking for. We can see the numbers in the financials, but how do we know from the qualitative side?
So it's a really good question. And that's the hard part about investing is you need to find an indicator for that company that you can see is important for them, but maybe other people haven't seen it. So there's not one specific indicator that I can give you. But what I was talking to Jason Moser from the Motley Fool, and he puts it very well, is he talks about what is the KPI, what is the key performance indicator for that company that other people might not see. So take a technology company, you hear people talk, like Facebook, for example, say they talk about their monthly active users all the time. That's a very well-known indicator as to how the company is doing. So think about what makes those companies successful and think about a qualitative metric that you can look at and do research on and determine if it's going in the right way, and think about an indicator that maybe not everybody is thinking about. And that's a great way that you can unlock a lot of value. And I also like, as a qualitative investor, to look at trends. And so what I mean by that is, I'll go back to MasterCard, is I personally believe that there is a huge trend away from cash right now. So what companies are gonna benefit from that? I think we're going to a cashless society eventually. So I look at that as a trend, and I'm very confident in that trend. But rather than trying to decide what winner is going to be of that trend, like which is the one specific company that's going to win, I like to buy a basket. So I buy MasterCard, Visa, PayPal, and Square. I have those 4 companies. They're all in the fintech space, and they all follow that trend. So that's a qualitative thing that I'm looking at. That's a qualitative trend. You can't really put a lot of data behind it, but you just get this feeling that when you go shopping, you're never using cash anymore. You never see anybody using cash. Nobody's using checks anymore. So rather than trying to pick the specific winner, I create a basket of companies that I think are going to benefit from that trend.
Okay, that's great. Great.
Okay, thanks, Chica. I'm gonna take, so you have some questions on your Facebook page.
Yeah, I can take one from there or a couple from there.
Right, see, you can go ahead and then we'll go back to our chat.
All right, that sounds great. So Samuel said, what effect do you think that these lower interest rates will have on company valuations? So when you're evaluating a company, the interest rate environment is one of the most important things. Warren Buffett talks about this a lot because you have, when you're doing a discounted cash flow analysis or you're valuing any type of company, you have a hurdle rate, and that's usually your interest rate. So you have a required rate of return to determine what the value of that company is. And if your interest rate, say, is 10%, your required rate of return for taking on all of the risk that comes with investing in the stock market is going to be significantly higher than 10%. So when you have a required rate of return like that, it's going to significantly reduce the value of that company. Now, if you reduce that interest rate to say 1%, now your hurdle rate is much lower. And so now your required rate of return is going to be, say, 5%. Now your valuations are starting to creep up because now when you're inputting that 5% rate in the valuation model, it increases the value. So that's how I think low interest rates are going to impact the valuations. We also had a question from Dara Chan. He said, what is your best investment to date and what is your worst investment? So my best investment to date has been in Apple. I bought that company. So it's a little bit of a funny story. I'll try to keep it quick for you guys, but basically when I was studying finance in college, for whatever reason, part of the curriculum was I had to study science. I had to take some sciences. So I was stuck in biology 101 as a freshman, and I was there to study finance. I wanted to learn about stock investing and all the world of finance, corporate finance as well. But I was stuck in this class learning about biology. So what I did was I would print annual reports. I'd sit in the back of the classroom and I'd read all of the annual reports I could on all these different companies while my teacher was teaching about biology. And one of the companies was Apple, and I made an investment. This was back in late 2013 or early 2014. I bought some Apple stock and I held it for a long time, and I eventually sold it, but that was my best return to date. MasterCard is up there for me. I've owned that for quite a while. That's done quite well. Visa has done quite well for me as well. So those are probably my 3 best. Now, my worst investment, which was the back half part of his question, honestly, I kind of forget the ticker symbol, but there's been a couple companies when I was first starting out. Thankfully, I didn't have much money at the time. So when I was investing, it was really small dollars, and it was a great way for me to learn. But basically what I was doing was I was buying quantitatively, and if something looks undervalued based on just quantitative numbers, you need to think about what is the catalyst that's going to make the market realize the value that you see in it. There's millions and millions of people investing in the market. And so while I do think there's value opportunities out there, I don't think markets are fully efficient. A lot of times the prices are already reflecting most information in the market. So you need to think about what is going to happen for this company that most people aren't expecting that's going to make the value increase, and what's going to be that catalyst. So there was some companies for me that I personally bought that did not do very well, and thankfully I didn't lose a ton of money. I think I sold out at 30% loss maybe. But I guess I would say my worst investment was a put option that I sold a few months back. I'm usually very, very conservative with my options, but this trade went against me, and there is significant downside when you're selling put options. And I lost a good percentage of money on that trade.
Okay. We have the final question now from Debra. Would you like to unmute and ask?
Sure, why not? Hello, good night, everybody.
Good night.
I'm sort of struggling with this a little bit, and based on how you speak so passionately. So how do you stay motivated? How do you stay driven and passionate for growing your portfolio?
Well, thank you. The passion comes through what I'm doing, because I certainly am passionate about it. But I guess my advice that I would give here is that if it's not something that you're innately passionate about, that is completely fine. You do not have to be. There's a lot of people that aren't. And in that case, don't buy individual stocks. Buy an index fund, continue to add to it over time, just consistently add to it over time, and don't touch it, never sell, and just continue to add to it over time. And you will do very, very, very well. And there is a lot of people that would argue that you would do better just buying an ETF and never selling it than people that are buying individual stocks. If anybody's familiar with J.L. Collins, he wrote one of the most popular personal finance books ever. It's called The Simple Path to Wealth. And I was able to sit down with him. We had a fantastic conversation. The podcast episode is going to come out about that soon. And he argues the strategy all the time. He says he's only bought index funds and just continues to buy them forever and ever. And his daughter, this is what his daughter does. She has no interest in, she's just not passionate about this at all. She doesn't really care about it. She doesn't want to learn about it. So she learns all she needs to know in order to buy index funds. And then she knows to just consistently do that forever. So if you're not passionate about it, don't force yourself. Buy index funds, hold them forever, and go do something else that you're more passionate about.
Thank you.
So we actually got just one more from Patrick. Patrick, would you like to go ahead and ask?
This has to be the very last question, though, guys.
Yeah, sure. Hey, Robert. So I was just curious on your investing philosophy. I know you mentioned you're 25. So I was curious just how whether your investing philosophy changes as opposed to like Preston or Stig, who are a little bit older, or if it's more just strictly focused on the value investing, like checklist, if you want to call it that, like just buying good businesses in general.
So I think it's not necessarily so much the strategy that changes with age. I think it's more so your allocation. Your portfolio allocation is going to change more than your strategy, because you could be a value investor until retirement. But when you're young, say my age, you might have 100% allocated towards stocks, and that you might be following a value strategy. But when you get to, say, 65, you still want to follow a value strategy if that's what you believe in. But now maybe you only have, 25% of your portfolio allocated toward a value strategy, and you have the rest in bonds or gold or whatever you decide to do with the rest of your portfolio. So I think it's more of a portfolio allocation type thing than a strategy. But for me, my strategy has changed a little bit, because I am a value guy through and through. And I think I probably always will be, but I have realized this, and it's partially getting a little bit more educated and understanding what value investing really is. But it's also my age, is that I realized that I'm only 25. I can buy a little bit more risky companies. I can buy a little bit more high growth companies. I still would argue that they're value companies. So MasterCard is considered growth by a lot of people, but I would still argue that it's a value play because of various different qualitative features that can go into that company that I think add significant value that is not being priced into the market. So I think it's more of a portfolio allocation thing than a strategy thing, but there could be a component of that if you think that you want to take in more risk because of your age.
Great. Does that answer you, Patrick?
Yeah, it does. Thanks.
Okay, awesome. All right, thank you once again so much, Robert. I'm sure it has provided a lot of value for most of us here. Surely it has for us. And we really do appreciate you taking the time to be with us and to share your experiences and your knowledge. So we are now going to continue. Yes, we're now going to continue into the next segment of our meeting,